Okay, let me start. Good evening, everyone, and very welcome to this CEPS webinar, the Greek debt crisis and the adjustment programs. What are the lessons learned? We have an excellent lineup of speakers to discuss this issue. But before giving them the floor and actually introducing them directly, let me say a few words about this topic. So we are exactly 10 years after the start of the Greek crisis. I'm sure many of you remember the early 2010, the beginning of the crisis, and then the escalation of the crisis. And then 10 years after, we're still talking about the Greek crisis. And I think this is a valuable moment, and we have a very important opportunity for doing so, because the Greek experience was a very peculiar one. Despite Greece is not the only member of the Eurozone who actually received financial assistance and went through an adjustment program, the Greek case is special. It has been a very difficult period for the Greek people, for the Greek authorities, but also for the EU, because when the crisis started, the governance of the EU, the structure of the EU and the euro area in particular, was not prepared to manage a crisis of such level. Actually, I was in an event on the same topic organized by a Greek institution, and there I was told that it's only now, after 10 years, that actually this issue can be discussed also in Greece without becoming too emotional or too polarized. So it took basically 10 years to digest this experience. So in this sense, drawing lessons from such experience is very important. And as I was saying, we have a special opportunity for discussing this and trying to draw lessons. And this is given by the fact that in 2019, Joachim Almunia, one of our speakers, he was appointed by the ESM Board of Governors to produce an independent evaluation of the ESM financial assistance to Greece. And we invited Joachim to share with us what the report finds about the Greek experience and to draw some lessons. Now, to react to his presentation, as I said, we have an excellent lineup of speakers. First, Jeroen Dijsselbloem. He was president of the Eurogroup during a large period during the Greek crisis. So it was one of those who lived actually the events related to the Greek crisis. And then Daniel Gross. Daniel is currently member of the board of CEPS and distinguished fellow at CEPS. Daniel and I have been working on Greece, the Greek crisis for 10 years. We recently produced a report focusing on debt sustainability. So excellent opportunity to discuss also our findings. And then last but not least, Baroness Minouche Shafik. She's director at LSE. And in the past, she was part of the IMF European Department, and she followed, at least for part of her staying at the IMF, the Greek program, the IMF Greek program. So with this quite long introduction, I would like to give the floor to Joachim to share with us his findings and his recommendations. Joachim, the floor is yours.
Thank you very much, Cynthia. Thank you very much to CEPS for hosting us to discuss this issue that, as you said, was extremely relevant when the problems started. The debt crisis started in at the beginning of 2010, and the third program to give support from the financial point of view to Greece, agreed by the EU or by the euro area, concluded in August 2018. So the ESM, as you said, has given me a mandate, and the president of the Eurogroup, the successor of Dijsselbloem, Mario Centeno, appointed me as independent evaluator for the second and the third Greek programs. So the evaluation report covers since private sector involvement at the beginning of the second program, the EFSF program, and concluded the evaluation after the first year of the post-program period at the end of the third quarter 2019. The report was agreed by the governors of the ESM, by the ministers of finance of the Euro area in June this year. And now Klaus Regling, the managing director of the ESM, has supported me to produce this report that we are now discussing with all of you in one series of debates to learn lessons of our evaluation. The evaluation report wants to draw lessons of what has happened and what was the treatment to the Greek problems from the Euro area point of view. And now this evaluation report tries to draw some lessons on the practice of the Greek programs during the last years. Let me go now to the first slide. What were the problems and the strategic objectives of the programs? It's very simple. The problem was the loss of market, or at least the threat of a loss of market for Greek debt issuance. The concern broader was the risk of a forced exit of Greece from the Euro area that was on the table several times during this period, and the Euro area integrity. And the fear were not only this loss of market and Euro area risks, but also the immediate fear of negative spillovers and contagion in other members of the Euro area, as was the case with some of them that also required financial support. The strategic objectives of the programs under evaluation were to preserve the Euro area integrity and the stability of the economic and monetary union, to restore financial stability in Greece as one of the elements to contribute to this Euro area integrity and stability, and to achieve sustainable and inclusive growth. I will first refer in the next slides to the conclusions of the report. The contribution of Greek programs to Euro area financial stability, in my view, taking the report conclusions, the integrity of the Euro area was preserved and the single currency restored confidence that was lost at the beginning of the financial crisis, in particular, but not only because of the Greek problems. During those years, there was an evolving recognition of the economic and monetary union design flows, the private sector involvement that took place end of 2011, beginning of 2012, the launch of the banking union in 2012, and the creation of the European Stability Mechanism, the ESM, also in mid-2012. There were limits, thanks to the implementation of the programs, to the negative spillovers to other members, and the experience of designing and implementing the programs triggered a greater focus on banking sector issues and not only on fiscal imbalances. On the Greek economy, which were the main effects? The report concludes that the stability of the Greek economy at the end of the program implementation was a qualified success. But there were weak foundations for medium to long-term growth, despite the huge amount of financial support and the number of reforms that were implemented during the program period. The programs, according to the report, had an excessive prioritization on fiscal targets, forgetting other very important objectives, or putting other important objectives into the second rank level. And one of the elements that we analyzed were that product market reforms failed to complement labor market reforms. That this created an imbalance with economic, social, and political consequences at the end of this period. The strategies for sustainable and inclusive growth. According to the evaluation report, the programs concentrated on delivering swift adjustment and stabilizing the economy. That was good. And they helped to implement or to put in practice stronger social safety nets in Greece, but only during the ESM program, during the third program. In the long run, potential challenges remain for the ESM due to long maturities of the loans given to Greece, and the ESM is the representative of the creditors in charge to be paid back of the huge amount of debt. Implications for Greek economy's resilience to shocks. As I said, the reform agenda is not yet completed at the end of the third program and in the year after this conclusion of the ESM program. Programs increase the resilience of the banking sector, but its shock absorption capacity remains weak, not only because of the present crisis, but at the end of the third program, this absorption capacity still had some objectives to be achieved. And program strategies challenge societal unit and little evidence of a fundamental transformation of the society. And this is not only a political challenge or a social problem, but also has to do with the weak ownership of the programs, as I will say immediately after this. The treatment of the program risks. The fiscal consolidation targets weighed on the growth necessary to reduce debt to GDP ratio. So the most important objective, the fiscal consolidation targets, the compliance with those targets, was not fully consistent with the fundamental objective of improving this debt to GDP ratio in a way that the final situation will be sustainable thanks to the growth path and to the growth potential of the Greek economy. There were disagreements between the Commission and the IMF on debt sustainability assessment that created difficulties for program implementation, and this was particularly evident during the third program. And subdued growth potential due to this lack of growth still represents a clear risk to Greece's long-term sustainability. A word on debt restructuring, that was an important issue. The private sector involvement in end of 2011, but really implemented in 2012, reduced Greek liabilities, but at the same time triggered a costly bank recapitalization. So the results of this private sector involvement were not as big and as positive as the member states wished. And the official sector involvement extended maturity further and reduced refinancing risks. And this took place at several moments of the period under evaluation, and in particular during the third program, not only, but in particular during the third program. The post-program release of policy contingent debt measures decided during the third program and after the conclusion of the program had contributed to this reduction of refinancing risks. And the Eurogroup, in any case, of the governors of the ESM, that are the ministers of finance of the Eurogroup, decided to review the need for additional debt measures in 2032, so in 12 years' time, just in case the objectives had not been achieved before this date. I mentioned before the problem of ownership. The institutions, included the Greek authorities, achieved a considerable degree of cooperation among them, and this is analyzed in the report, but the parties did not share diagnosis and solutions. Sometimes cooperation existed, but not based on a common diagnosis and on the support of common solutions. The Greek authorities showed over time a volatile ownership of program reforms with different periods, with higher ownership, but followed by weaker ownership. Synergies with institutions other than the ESM, the Commission, the Eurogroup, the ECB, and the IMF were insufficient, but also sometimes synergies within these institutions were not fully positive. And there was a lack of coordinated and comprehensive communication and advocacy. Let me now go to the recommendations of this report. These are recommendations under my exclusive responsibility as evaluator. Regarding the strategic program objectives and design, my recommendations are the following. The future ESM programs must clearly define the strategic objectives based on a long-term view. Growth in the beneficiary country, in this case in Greece, is a necessary condition for the success of every program. And this is true in the case of Greece, but in the case of other potential beneficiaries of ESM programs in the future. The program design should derive its objectives and length from an analysis of the main problems to be tackled, and not only on one particular objective, as was the case of fiscal targets, for instance. All programs should ensure a fair distribution of efforts across society. I referred before to the low degree of ownership, and this unfair distribution of efforts during the implementation of the programs is indeed one of the elements to be taken into account to assess what are the reasons why the ownership was not as high as we wished. The program should establish a limited number of macro-critical conditions at the end of the second program, the FSF program, and during the implementation of the ESM program, the number of conditions to be assessed by the institutions before authorizing the next payments to Greece was increasing more and more, and made impossible a sensible way to assess which were the macro-critical conditions, the relevant conditions. And programs should establish an appropriate sequencing of reforms. I referred before to this lack of synchrony between the labor market reforms and the product and services market reforms. On the preparation and implementation of the programs, recommendations are, the main recommendations are three. In my view, the sustainability assessment needs a broader focus beyond debt levels and the fulfillment of debt and deficit targets. The program approval should explicitly assess exit strategy options, and not only, as was the case in the ESM program, the generation of a cash buffer, and also a post-program incentive structure, given the long-term maturities of the loans and the duration of the programs. All in all, the 3 Greek programs took 8 years, but the problems cannot be solved only during this period. And building and improving a beneficiary country's institutional and administrative capacities require cooperation between institutions. And as I said, this cooperation existed, but with some failures and with some problems that can be tackled, can be solved in the future. And final group of recommendations, the post-program engagement. A strong and coherent framework for post-program monitoring is needed to safeguard adjustment gains and ensure sustainability. The ESM, but also the European Commission, under its own responsibilities that are very important, must pay attention to the role of advocacy, not only paid attention to the peer pressure and to the market pressure, but also to define a strategy of advocate what should be done, what can be done, and what are the tasks that are still not finished once the program is concluded. The ESM must strengthen relations with the authorities of the beneficiary country, as well as with political forces, not only the parliament, but all the political forces and civil society. We found during the evaluation that these contacts beyond the authorities were not as intense as it should be, and to develop capacities to be aware of the interconnections and potential negative spillovers with the other euro area countries is needed. Let me final words on the after evaluation period, after the program period. Now we have the COVID pandemic with very strong shocks, not only on Greece, but also in Greece and in other economies on the euro area. At the end of the evaluation period, Greece was on a recovery path. After the program was concluded, economic and institutional reforms continued. Now we will have, hopefully today, the European Council will solve the final problems for the implementation of the new generation EU. And we also have SURE plus EIB schemes to support the economies and the ESM new facility. All these can provide substantial resources for Greece, but there are doubts about the absorption capacity and the degree of ownership. There are positive elements, the declining cost of finance, the efforts to buttress implementation capacity, improvement in confidence, attention to privatization, but there are also challenges that have not disappeared and are again on the table during this new crisis. The fiscal space is under pressure by the pandemic expenditure and the lack of revenues, persistent unemployment, resolution of asset quality issues, in particular non-performing loans in the big Greek banking sector, has still a lot of work to be done. And there is a clear need to increase investments in both private and public investments. And the question mark at the end of this presentation, what are the new elements that can be provided after the reform or the review of the ESM treaty has been agreed recently? The ESM has established a new pandemic instrument. The ESM treaty reform adopted last month establishes a backstop for the Single Resolution Fund to reduce fiscal burden in case of large bank restructuring costs. There are provisions for the new collective action clauses that will come into force in 2023. And the ESM has the responsibility to monitor the economies, not only the economies of the old program countries, but all the economies of the euro area beyond the current enhanced surveillance under the responsibility of the European Commission and beyond the early warning system that is in place for the ESM. So these are my comments at the end of this, very quick presentation of a report that you can get access to the full report in the ESM web. Thank you very much.
Many thanks, Joachim. A lot of food for thoughts. I actually have myself a number of questions. I will keep it for myself for the moment. I would also like to invite all the attendees who would like to ask a question to use the Q&A function, which is at the bottom of your screen. You can type the question just by clicking on the icon Q&A. Now, let me move to the comments. Now, Joachim, in some of your points of the evaluation, you mentioned elements which were related also to the political dimension. In fact, in the Greek experience, economics and politics played together an important role. And I think Jeroen is very well placed, given his role at that time, actually, to try to identify and to disentangle to what extent actually politics and the political element played a role in the Greek experience. Jeroen?
Thank you, Cynthia. I just had to unmute myself. Thank you for the invitation and the opportunity to discuss with you the Greek programs. And many thanks, of course, to Joachim for the work he's done on this. I hope you'll forgive me when I go back in time a little bit, because there were 3 programs and there were already major problems in Greece before the programs were put in place. If you go back in time, even before the crisis, sovereign debt in Greece was already very high. Greece had lost competitiveness drastically in the period before the crisis, had a high deficit, even though we were only going to find out the exact figures later. And when the real figures came out, there was also a huge issue of trust and trustability. And this was at the start of what were going to become 3 programs. So Greece had, from I guess the 5 program countries, the worst starting position possible. And a political system that had shown little responsibility for the major problems that were building up. And that is a criticism that can go to the political class in all of our countries, but it was pretty extreme in Greece. I think in the first program, 2 major mistakes were made. One was that the bailout of banks took place. It was basically a bailout of the investors in the Greek banks, and it drastically increased the already high Greek sovereign debt. The second one was that once the fiscal figures were open on the table, there was so much anger and distrust that the fiscal targets that were imposed on Greece were extremely drastic. If I remember correctly, the deficit was at -15 and Greece was forced to reduce it to below -3 in 2 or 3 years' time. I mean, it was an effort which came, of course, at a huge cost socially and economically. The second program I had a small involvement with. I became a minister at the end of 2012, and there was a redesign of the second program. It had already gotten into trouble for the simple reason that it wasn't realistic. The targets weren't realistic, the figures of growth weren't realistic, and it had to be redesigned and refinanced halfway. And that was certainly one of the moments when already the debt was restructured. The PSI had just taken place. This was before my time, but also the official sector players then decided to lengthen maturities and reduce the risk premiums and lower the interest rates. The third program was in many ways different. By the way, at the end of the second program, I remember this. So we had that in 2014, Greece was back into growth. Some stability had actually returned. Unemployment started going down. Investors were actually returning to Greece. And I remember the atmosphere at the end of the second program of some optimism, and perhaps in Greece, too much optimism, certainly among politicians. And their already thin motivation to work on the program and to deliver on the many measures that had to be taken really diminished. There was an election coming up, so their motivation to conclude the second program was very thin, and basically we were unable to conclude the program before that election. So it was a complete misjudgment, I think, on the side of the Samaras government at the time of where they were economically and where they were politically. And then, of course, at the beginning of 2015, we entered into a very difficult time with the Syriza government, who basically said, we don't want another program. You have to simply write off the debt. And by the way, can we have new loans? And the political context here became very, very agile very quickly. It was really a terrible atmosphere to work in. The pressure was enormous. You all remember the summer of 15, the difficulty we had to redesign the conditions that were being negotiated. Still, looking back, I think Joachim makes good points about the good points and the bad points of the program. The program was, again, I think, overloaded, too many conditions, and there were no clear priorities. And And again, I think we overestimated the ability of the Greek public sector and certainly the political sector to deliver on this agreement. Even though I must say that actually the implementation of the third program was more smoothly than the second program, strangely enough. It was extremely difficult to get to the third program to achieve the agreement. But after that, the implementation, certainly the political process around it, was much more smooth. We didn't get the order right. This is a very important point that Joachim makes in his report. There had to be an internal devaluation to improve the competitiveness of the Greek economy, to allow for a better balance in import and exports. Yet, it's very important to get the order right, to open up product markets, reform product markets, before you enter into reforming the labor markets. In other words, there has to be more economic opportunity before you implement labor market reform, pushing down wages in order to regain competitiveness. That order was not designed well, and that had a huge, also contributed to the huge social impact. What did we get right in that third program? I think there was more front loading, which was a mistake in the second program. So more difficult measures were right at the front of the program. There was more attention to social aspects. We did a bail-in on the banks, saving Greece, I think, 20 billion euros. We spent a lot of attention to the governance of banks, which I think is crucial. This was a point that Christine Lagarde made very often in the Eurogroup. You can put as much money in those banks as you want. If they're not run properly with sound ethical governance, it's a waste of money. We spent a lot of attention to that. Debt sustainability, the thinking about debt sustainability was shifted, changed, though the IMF, of course, did not agree. We took a broader view, not just the debt level, but also basically the debt burden, looking also at what the costs were of the annual servicing of the debt, as well as maturities. So there were a number of critical issues which I think we really need to learn lessons from: more priority, clearer package of long-term goals, and taking seriously into account what a country is able to implement in the given period of time. All in all, the programs were too long, the crisis went on too long, and that is also problematic from a point of democratic legitimacy, because coming to an agreement on a program means also coming to agreement on, very often, inevitably, intrusive measures, which have been agreed at outside the domestic democratic arena. So really, this may be necessary and inevitable in times of real crisis, but when such a crisis lasts for 8 years, it really is an issue. And we were criticized, and the Eurogroup was criticized for this, the intrusion on the democratic process in Greece and also in other countries. And it's a dilemma that I haven't solved it yet, but I know that the longer this intrusion lasts, the bigger the issue. I'll stop here. Thank you.
Thank you very much, Jeroen. And now I'll give the floor to Daniel.
Thanks a lot. As you can imagine, after having these heavyweights presenting the political background, I will turn more to the economy. And I will try in particular to avoid playing what the Americans call Monday, quarterbacking, right? Quarterback playing. Starting with things which were known at the beginning, and which, if I may say so, Cinzia and I already pointed out, I think, in a paper of 2009-10, thereabouts. And the first point I wanted to make is that keep in mind that the Greek program was at least from the beginning, a standard program, like many IMF programs and the other programs in the euro area, most of which succeed. And the basic economic mechanism behind all these programs is very simple. You have to cut the fiscal deficit. That reduces demand. In the short run, we can discuss whether the multiplier is 0.5, 1, or 2. And the only way the country can then get back on its feet is by basically exporting. Right? Because you start with a deficit, nobody gives you capital, so you have to arrive at a balanced balance of payment. Right? And if you want to do that with some growth, you have to increase exports. And the first simple conclusion is that is easier if already at the start, exports were an important part of your economy. And when Cinzia and I looked at the data before the crisis, we were very surprised. Greece was one of the few small closed economies. We had never seen anything like this. Very small economy where exports were 10, 12, 15% of GDP, where normally in other economies they're twice as much. I make a quick parenthesis here. The only other case we have seen that is Argentina, I think, which tells you a little bit where programs succeed, right? So one knew from the beginning that program would be tough, right? And it all depended basically in succeeding upon the ability to get perhaps from a small basis, a big boost to Greek exports. And if you took the experience of other countries, you would say, okay, Greece will take a bit more, but it will come. And the big surprise year after year was that Greek exports did not increase. Or let me say, did not increase as much as would you have expected. I'm a bit surprised Joachim didn't mention that, because we had at the similar time Portugal, in terms of GDP per capita similar, initial GDP, deficit ratio similar, debt ratio a bit lower, with one difference. Portugal was at the beginning a bit more open than Greece. So exports played a bigger part. But then comes the big surprise. In Portugal, you had very little internal devaluation, but exports increased by 30, 40%. Right? And if you have, let's say, an export to GDP ratio of 25%, they increase by 40, you get 10 percentage points of GDP in demand, which can offset a lot of fiscal adjustment. That's what happened in Portugal. In Greece, you had much more internal devaluation, and exports still did not increase that much. Now, was that due to the political factor which Joanne mentioned? I don't know, was it due? But that is just, I wanted to give you the background to these continuous difficulties. If by miracle Greek exports had behaved like Portuguese ones, I think we wouldn't have needed the second and third and fourth program, because the economy would have back on its feet, the capacity to service its debt was much higher. So this is, for me, the economic background. You start with a difficult case, and then surprise, it's not only difficult, but super difficult, right? It doesn't even move in the direction you want the country to move. And that was, I think, difficult to anticipate at the very beginning. And that, for me, is the key point. The background to all the difficulties, also the background then to the fact that Portugal didn't need a debt cut, whereas Greece did. Maybe there's, if I have time, Cinzia, I want to mention one other element which also comes out from one study which we did, which is that, to my surprise, when you look at the experience of many other haircuts to sovereign debt in the world, and you look at the debt to GDP ratio before and after the haircut, in most cases, you don't find that it has diminished a lot. Right? That seems to be something which happened not only in Greece, you shouldn't be surprised, it happens in many cases. And given the very high cost of a haircut, I would say maybe in future we should think twice about it. On paper, we say we reduce the debt by X billions, and therefore debt ratio goes down. But as a matter of fact, in the end, in experience, you find very often that it doesn't really help. Part of that, again, was knowable beforehand, because we knew at the beginning that a very large proportion of the debt of the Greek debt was held by Greek banks. And we knew that this is left pocket, right pocket for the Greek society, right? You cannot cut that debt because otherwise the banks don't exist anymore. The country cannot grow. So it was already known from the beginning. It was going to be a tough case. That was going to be difficult to cut the burden by just the haircut. And that the key issue was growth, in particular growth of exports. In my view, the programs didn't put enough emphasis on that, but I must also say, I don't know a miracle cure. I don't know a button you can push to say, exports, please grow, right? But in terms of the one criticism I would make is more emphasis should have been put on that particular economic mechanism, acknowledging that maybe the chances of having a big success would have been very limited. Thank you, Cinzia.
Many thanks, Daniel. I will now move to Minouche for sharing with us her thoughts.
Thank you very much. And it's a real pleasure to be here. And I very much welcome the very comprehensive evaluation that Joachim has done, which brings together many perspectives on the Greek program. And as you said, Cinzia, 10 years is a good time to look back with at least a greater degree of objectivity than when we were all in the fog of war. For me, I was Deputy Managing Director at the IMF for the first and second Greek programs, and I oversaw them, but I also oversaw Portugal, Cyprus, Iceland, and the Spanish bank restructuring programs, which were far more straightforward, I would say, than the Greek program. And I very much agree with many of the recommendations in the evaluation, but there was a few that I wanted to particularly highlight. First, the balance between fiscal and structural reforms. And the evaluation says that the choices that were made left Greece in a sort of low growth recovery, which made the political sustainability of the program much harder. I think what's interesting to note is that the preference for relying more heavily on fiscal adjustment was one that was politically convenient for all parties. I think on the Greek side, there was an unwillingness to confront vested interests who would have resisted structural reforms and product market reforms. And on the European side, the Commission was very wedded to the fiscal targets and wanted to see those delivered, certainly in the first and second programs. And while it was more convenient for all sides to emphasize the fiscal adjustment more in the short term, I think in the medium term, it very much undermined the sustainability of the program. And I think the evaluation makes that clear, that the sort of low growth recovery was politically very problematic. I think the second point the evaluation makes, which I very much agree with, and I think we've all learned that lesson, is around macro criticality and the far too complex set of conditions, particularly, which just overwhelmed the capacity of the Greek state. And clearly more focus, a narrower set of conditions would have been far better. And I think that lesson actually has been learned by all sides. The third point I'd make is a lesson that we keep saying, but we never seem to learn, which is that you can't create political will through conditionality. You know, we all talk about the importance of ownership, and I say that from every adjustment program I've ever been involved in at the World Bank, at the IMF, in developing countries, in Europe, everywhere. But every single time we're in a crisis, we have the triumph of hope over experience. And we hope that having more conditions will persuade the government to abide, to create the political will that's just not there. And, you know, I do think we have to ask ourselves, how will we really learn this lesson? If we really learn this lesson, we probably have to walk away until the political will is genuinely there. The fourth point I'd make is that like every debt restructuring story, we have a lesson, which is we should have done it earlier. We should have done the debt restructuring early. And everyone remembers the phrase kicking the can down the road. And every time we kicked, the can got bigger and bigger and bigger. And with every sovereign debt crisis, there's always a conclusion that, if we had acted earlier, it would have been much better. And yet again, the politics work so much against that. The report shows what an important and useful role the introduction of CACs had, the collective action clauses, in facilitating future debt restructurings with private creditors. I do wonder whether we need to think about a CAC-like mechanism for public sector creditors. Given that most of the debt is now official, I think the need for unanimity among sovereign creditors has delayed debt restructuring in many, many cases. Jeroen will know well that the need for unanimity in the Eurogroup slowed progress on many, many issues, including the debt restructuring. And so I just wonder whether we need to think more and harder about a CAC-like mechanism for public sector lenders. And this is obviously I think this is a lesson not just obviously for the Eurozone, but going forward, future sovereign debt restructurings will, already, one need only think of the role of China in funding many emerging markets and how that will be handled in the context of future sovereign debt restructurings, and how whether we need a majority vote to enable restructuring. I think the pandemic funding may have changed the weather on many issues, including the appetite for mutualization, which has been the perennial debate in the Eurozone, and also the appetite for mutual investment. And so it will be interesting to see whether that precedent changes the debate in the future. And I'd be very interested in hearing the views of others on that as well. I'll stop there.
Many thanks, Joachim, for you to respond to all these easy questions.
Yes, well, thank you very much for all the comments of the three discussants. I will not go point by point of the many interesting issues they raised. Let me just go very quickly to what I think are the more relevant issues. First of all, start by your own points, trust. In my view, it was clear that since the beginning, or better, before the beginning of the public debt crisis, trust between the Greek economy and authorities on the one hand, and the Euro area institutions and politicians on the other hand, was at a very, very low level. You mentioned in passing the statistical discussions that created a huge lack of trust. This had started well before the financial crisis. When I arrived to the Commission in April 2004, there was a huge discussion on statistical problems in Greece in 2004. And again, these problems appeared in October 2009. Well, appeared. They never disappeared between 2004 and 2009 because the member states, not the Greek authorities, the member states of the Euro area, in particular the most relevant ones, didn't authorize the Commission to have audit responsibilities on going on the spot to look at the figures before they were sent to Brussels. So the Commission was trying to organize surveillance, fiscal surveillance, based on figures that were not reliable, but that the Commission had not the powers to check on the spot. Lack of trust that indeed was at a very high degree at the beginning of the first program. This is not under the evaluation of our report, but you can find analysis in our background papers and in some parts of the report about what has happened before the EFSF and the PSI exercise. And these problems were tackled not only with lack of trust, but also, if I may, with some wish to punish those who were not reliable. This played, in my view, a role also during the first program. The EU was not equipped to deal with those programs, and at the same time, in the particular case of Greece, there were particular pressures to create a very tough example of what needs to be done. This is my view. This is not in the report, by the way. It's a totally personal view. The forecast of the programs, mainly the first and the second, were not realistic, were more political forecasts than economic forecasts on both sides of the table. They were keen to have a very optimistic forecast under the assumption that this could not be implemented or it was impossible to be achieved. And the third question, the political problems around the third program that you knew very well since the beginning. There were serious political problems before the third program was signed and agreed in August 2015. And there were political problems on how to put an end to the ESM program in 2018, because it's true that 8 years is too much. And you can create serious political problems, bigger than the ones were created during those years, if you continue to insist in the need of a fourth program of the longer duration of programs. It is my political assessment that I think I concur with your reading. Regarding Daniel, one comment. You said, and you are completely right, the first program was a standard IMF program, of course. And I recommend, in one of my first recommendations, to deepen and broaden the understanding of the economic conditions of the countries that will require a program. It's not only about fiscal imbalances that, of course, are relevant. It's not only of some standard structural reforms that are needed in many economies, but you need to understand not only the needs of prioritizing the reforms and combining the adjustments with the path of reforms and the priorities, you also need to understand what is the implementing capacity of this country. And it's very difficult from the EU point of view, knowing the European Commission, as is my case from the years before this first program of Greece. It's very difficult once you have a member state, not a candidate, but a member state, to have the adequate instruments to reinforce the implementing capacity, to improve the way the public administration works, to improve the efficiency in the providing public services, and so on and so forth. And this was clearly one point that, in my view, created differences between Greece and Portugal. If you look at the macroeconomic figures, okay, they looked pretty similar. Not exactly the same, but pretty similar. But if you know well the Greek economy before 2010, you know that to allow the Greek industries to be competitive and to increase the external markets was not a deal, it was not a task for 3 years, for 5 years, and maybe not for 8 years. It's a longer period that is required to create the conditions to transform an almost closed economy, maybe with the exception of tourism, into a medium-sized country with exporting capacity and the way to maximize the positive effects of an internal devaluation. If you cannot export, the internal devaluation will create more recession, not more exports. And with the Minouche comments, the points, I agreed with most of them, if not with all of them. The low growth equilibrium that is analyzed in the report was evident. The fiscal adjustments were achieved, in particular during the third program, but the price was the lowering of public investments that were forgotten, and the adjustment was used in the third program to create a social safety net and other social purposes, including, by the way, to improve a little bit the amount of the amount of pensions, because pensions played a very important role as a safety net in Greece. That is what it was not the case in other euro area countries. But this low growth equilibrium that is signaled in the report, it creates strong difficulties for potential growth and for the long-term sustainability of the Greek economy. Indeed, I fully agree, as the report does, with the increase of conditions, not macro-critical conditions, but any kind of conditions. The political will cannot be created with more conditions. I fully agree with this. Ownership is a question to be thought not only in economic terms, or even not only in economic and social terms. It's a political issue that requires political feelings that cannot be decided, with all my respects, by the Economic and Financial Committee or by the Eurogroup Working Group. This requires a political level to think seriously how to improve ownership, and to react earlier, of course, is always the question. In the report, and I conclude with this, we put an emphasis in the need, if possible, to decide the banking sector adjustments and reforms and the debt restructuring or reprofiling upfront, not as the second, the third, or the fourth objective. This would be tackled upfront. If the banking sector would have been in a better position in 2015, 2016, and not with a big load of non-performing loans, it's possible that internal private investment in Greece would have improved. It's possible. But in any case, it's a lesson that we can draw from the Greek experiences. Thank you.
Thanks very much. There are a lot of questions which have been typed in the Q&A function. Daniel already replied some of them. I assume that actually everyone can see them. There are very short answers. So maybe we start with those who are still, which are still open. There are a number of actually follows up on points which were made by Joachim also in his responses. There is one about the comparison between Greece and Portugal. I think Daniel wants to respond to this one, and the fact that the Portugal advantage was due to the fact that they had a traditional export capacity to Africa and Latin America. Daniel, is that can this explain the difference in the performance of the two countries?
I don't want to go now into the very detailed question. When we looked at the time, again, ex ante, we thought that the boom in the Middle East, Turkey, and the broader Middle East, where Greece was present, would have provided a priori at least a similar booming market, similar opportunities at least. So yes, Portugal might have had a broader, whatever, base to which it could export, but I think Greece had also a booming economy on its doorsteps. So I don't think that explains a lot. Can I add something else? Sorry, no, it's Jeroen.
Jeroen?
Just on this difference between Greece and Portugal. Now, Daniel has looked at it much more closely, but my idea is that Greece has recovered from, let's say, a negative trade balance of minus 12% GDP to just below zero. Portugal has gone from minus 10 to just above zero. So this sort of big difference that you're describing, I don't see that in the trade balance figures since 2008.
if I can just say, for me, the key point was not so much the trade balance, but the fact that if you export 40% more, then you can also import more. Right? You can consume more, have a bigger GDP, and also import a bit more. So that's why the key thing is to get the economy going, create value added at home, which you sell abroad. And then also you can also import more. If you don't increase your exports, it means your consumption possibility are down for the next generation.
Yeah.
And there, I think that the lack of product market reforms were a big reason why exports never took off.
Yeah.
So no matter how much you internally devalued, you never got the product market reforms that motivated higher output.
I agree. One thing that I recall is that in Portugal, before and after the elections, the incoming and outgoing parties supported the program. And maybe they were forced to put their signature, but that was such a difference with Greece. If you remember how Papandreou was treated both by the Europeans and by the Greek opposition, Samaras never said he would support the program. And then, of course, he became prime minister and he had to implement it, but he was never committed to the second program. And when I was chair of the Eurogroup, their commitment to finishing the second program was non-existent. And I think that was a big difference between Portugal and Greece. In Portugal, there was two major parties who took responsibility and said, okay, we'll sign up to it and we'll do what is necessary.
There is a question.
If I may, Cynthia, very quickly, as Portugal is my neighbor country, and even if I was not directly involved in these programs of Portugal, but I can say that in my view, the institutional and administrative capacities are different, were different during these years, even if the imbalances were also big in Portugal, but the degree of consensus in the functioning of the institutions, the relation between government and opposition was not as tough as in Greece, and the implementation capacity of the Greek ministries, in my view, was better than in Greece. These two elements created more trust, not only between Portugal and the other Euro area countries, the lenders, but also confidence in investors, in economic agents, and in the society. The degree of ownership in Portugal was not very high, but was not as low as in Greece. So the political task of the Portuguese governments was not as difficult as in Greece, of course, in my view.
Can I ask a question? I mean, did it make the difference that Greece was the first player? So it had a sort of disadvantage because it was the first country to be in trouble. So those who came after could learn from it, or not necessarily.
I mean, Iceland wasn't in the Eurozone, but Iceland came before Greece. And Iceland had a pretty stellar adjustment with really good social safety net and a pretty rapid economic. I mean, they took some drastic measures in terms of capital controls, which they could do because they weren't in the Eurozone. But maybe that's not a relevant precedent, but it preceded Greece.
Let me mention another precedent outside the Euro area. When I was Commissioner for Economic Affairs, we had 3 programs of financial assistance for 3 non-Euro area countries in 2008 and 2009. First of all, Hungary, not Orban's Hungary, but the previous Hungary authorities. Latvia, it was a very tough adjustment, but with a fantastic cooperation of a government whose prime minister was Valdis Dombrovskis, the present vice president of the Commission, and Romania. These 3 adjustment programs, in particular the Latvian one, was very, very tough and very big in relative terms, with a lot of social sufferings of the Latvian population, but with a very positive results at the end. By the way, on the other program countries of the Euro area, you can have the evaluation report mandated by the chairman of the Board of Governors, Jerome Dijsselbloem, and agreed in 2017. And this the Greek evaluation report that we are discussing today was charged because at that time in 2017, the ESM program was not concluded, was being implemented, and then the governors requested a new report at the end of the third Greek program. But the evaluation of the programs in Portugal, Ireland, Cyprus, and Spain, in the case of the banking sector in Spain, is available since 2017, and I think is a very, very good evaluation report also, comparing the results in different countries.
And of course, also in time, Ireland and Greece weren't that far apart. And if you look at the Irish program and how that came out, how that was implemented, was again very, very different from Greece. There was also a big similarity. It was in how the banks were dealt with. And all of this was because the big European countries, I think Germany and France certainly, I'm not sure where the IMF was in this debate, did not allow for a bail-in on the banks. The banks had to be saved at the cost of the national domestic taxpayers. And that happened, it happened in all the countries, but the impact of this thinking, of this approach, was the biggest in Ireland and in Greece.
Yeah, it's true. I think the IMF did not wanted to do a bail-in, did not want to save the Irish banks, but were outvoted, basically. Whereas Cyprus is another good example where bail-in was, it was tough, but it was successful. And, Cyprus and Greece have a lot of similarities in terms of their economies, structures, and so on. Although probably institutional capacity in Cyprus was also a bit better, but the bail-in was successfully implemented.
There is one question asking whether actually corruption was important in affecting the lack of success of the programs. Anyone would like to say anything?
Well, it goes back to how strong and trustworthy are your institutions. Now, corruption is a very broad theme. If you would include not paying taxes when you should, if that's corruption, then yes, that is a huge issue. And in all the programs, it was a huge issue. How can we improve the tax system? By the way, also make it fairer in the process, because those poor people that were paying the taxes were confronted with ever higher rates to keep getting some tax income flowing to the Greek government. So the poor people who were paying much more every year, and a large group was not paying or using all legal means to postpone payment. Now, whether that's corruption, I don't know for the official definition, but that was a big issue in the program.
There is one question which has been typed in just now, but I think it's quite interesting. So Greece came soon after the Lehman Brothers collapse, so an environment dominated by this event. Do you think it would have been different, in terms of support for Greece if we were not in the specific moment? So in practice, do you think that Greece would have been let down?
Well, sorry, Jeroen.
No, go ahead.
Well, it's very difficult to do this kind of counterfactual scenarios, but in my view, the imbalances that were generated in Greece immediately after his entry into the euro area and the lack of structural reforms and institutional improvements that were needed even before Greece entered into the euro area created an extremely high risk scenario. Nobody could say, okay, without Lehman Brothers, the debt crisis in Greece would have exploded later on. Probably yes, but the structural problems and challenges of the Greek economy and of the Greek political system were present well before Lehman Brothers exploded in September 28. You have, as in the website of this of the SM, together with the report that we are discussing and the background papers that were charged, one of these background papers is an analysis about the origins of the roots of the Greek economic problems, and I think is not an evaluation paper; it's a background paper that we use to try to understand the origin of the Greek problems before our evaluation period, but it's extremely telling. What are the real problems, not only economic, also political problems that were created a very risky situation in Greece before 28.
I think, Cynthia, to answer your question in a different way, Greece may not have been saved, there may not have been a program had there not been a risk for the Eurozone in total. And for a very long time during the financial crisis and later on the Euro crisis, countries were felt obliged to help, to step in because of that overflow of risk, the risk to the Euro and the Eurozone in total. And that we almost came to a turning point when Wolfgang Schäuble in 2015 basically said, well, keeping Greece in the Eurozone is now a bigger risk to the Eurozone than pushing them out. And that was a change, because in the years before that, the general understanding was that the Eurozone really couldn't afford to let anyone go, because it would become a systemic issue and it would question the future of the Euro as a whole. But in 2015, that almost tipped to the other side. I didn't agree with that. I think that preserving the integrity of the Eurozone is a huge political effort that we must put in. And luckily, our government leaders in the summer of 15 agreed with that and said, however difficult, we're going to keep them in. But I remember a non-paper by Wolfgang Schäuble, which said they should exit. At least,
it's called the holiday, no?
Yeah, at least for 5 years, if I remember correctly.
Longer?
Longer? Oh, okay.
I don't know. Daniel, want to say something?
Just, of course, this was just a pretext. It would not have been 5 years. Once you're out, and a generation, right? And I think I totally agree with you. I just wrote it also in the chat. This was a political decision. On the pure economics and financial markets, one probably could have said the Eurozone can take it. But I also totally agree with you. It was the right political decision to take, to go the extra mile to keep Greece inside.
But if I am not wrong, during the first year or year and a half of the Greek debt crisis, since the beginning of 2010, the first program and the adoption of the second program, this Wolfgang Schäuble position in the non-paper of 2015 would have received the support of many other finance ministers around the table. In 2015, and Jerome knows much better than any other person, probably Schäuble had not received the support of a couple of finance ministers. So the analysis of the risks of a Grexit in 2015 was a political analysis. In 2010, 2011 was not only a political analysis, was also an economic analysis for the weakest economies of the south of the Euro area that fear the risk of immediate contagion of a Grexit.
Exactly, yeah.
Okay. Minouche, would you like to add?
Well, no, I was just going to add to what Joachim said. In the earlier phase, the spreads were contagious. By 2015, it was a different world. And, French spreads and, we're not going where they were in 2011 and 2012.
Okay, we have reached already the end. We are already 2 minutes out. It's time to close. The discussion was extremely interesting. There are actually a lot of unanswered questions, so I apologize to those who asked questions and we couldn't answer. I will not even try to summarize all the lessons that were drawn. I have a long list. I'm sure we can definitely write up something. I would like to thank you all for the frank discussion. I think it was very frank and open discussion, and I think this is much appreciated by all. And I wish you a good evening. Many thanks.
Thank you.
Thank you very much, Cynthia.
Bye.
Thank you very much to all of you.